Welcome to The Explainer. All right, let's dive right into this fascinating mystery surrounding TransMedics Group, or TMDX. Now, if you follow the medical technology sector at all, you already know TransMedics has been making some serious waves with their organ transplant technology. But you know what? Today, we aren't looking at their medical devices. We're looking at a bizarre, honestly, massive financial dichotomy happening right now between their balance sheet and their stock chart. We're going to let the data tell the story of one of the most extreme financial disconnects currently sitting in the market.
We've got to start with a pretty stark reality here, negative 43.82%. This massive negative number is TMDX's year-to-date return. Right out of the gate, this establishes the market's overwhelmingly bearish sentiment toward the stock right now. Look, if you're a shareholder checking your portfolio this year, this is a painful metric to look at. The market has just aggressively sold off this equity. And naturally, your very first instinct when you see a year-to-date drop this severe is to assume, well, the underlying business must be in deep systemic trouble, right?
Just to really put that drop into perspective, look at this dramatic 56.19% plunge. We're looking at a 52-week high of $156, which they hit back in December of 2025, directly compared to the current trading price of just $68.34. I mean, more than half of the company's market cap has simply evaporated in a matter of months. When you see a chart just falling off a cliff like this, it immediately poses a serious question. Is this company actively failing? Have they totally lost their competitive edge? Or are the revenues just drying up?
Well, let's look at the actual business fundamentals. Because what's really interesting here is how these explosive compounding annual growth rates totally contradict that stock price drop. Look at those bars. Over the last 3 years, revenue has grown at a compound annual rate of nearly 75%. But even more impressively, their net income has grown at a 3-year CAGR of 100.48%. Let that sink in for a second. While the stock price has literally been halved, the actual net income, the pure profit the company is generating, has been doubling annually over a 3-year timeline.
And hey, if you thought that net income growth was impressive, look at this one, 339.17%. The staggering number is their trailing 12-month free cash flow growth. We all know cash is king, right? And this metric firmly establishes the disconnect narrative between the business's real-world performance and its stock price. Guys, a company generating over 300% growth in free cash flow is not a failing business. It's a cash-generating machine, and yet Wall Street is pricing it like a distressed asset.
Section 1. Valuation multiples and pricing the disconnect.
So, looking at these core valuation metrics, a price-to-earnings ratio of 16.16 and a price-to-sales ratio of 3.70 are actually remarkably modest for a company pulling in triple-digit income growth. But pay special attention to that bottom row, the PEG ratio, which, as you know, measures price to earnings relative to growth, is sitting at an incredibly low 0.07. For context, value investors traditionally consider a PEG ratio of 1.0 to be fairly valued, so a PEG of 0.07, that signals that the company's growth is being priced almost unimaginably cheaply by the broader market.
This perfectly illustrates just how entirely disjointed current valuations are from this company's own historical norms. The market used to pay a massive premium for TMDX. Today, the PE ratio is down over 92% from its 3-year average. The price-to-sales ratio is down nearly 61%, and that crazy PEG ratio we just talked about is down 95% from its historical average. The market has completely changed how it values every single dollar of earnings and sales this company generates, essentially just compressing the multiple right into the floor.
Section 2. Profitability and health check. These robust health metrics paint a very clear picture of what's going on under the hood. A current ratio of 6.74 means they have nearly 7 times the short-term assets needed to cover their short-term liabilities. Their return on equity is a phenomenal 34.80%, which shows incredibly high efficiency in generating profits from shareholder capital. And they're doing all of this with a super healthy net profit margin of almost 20%. These metrics definitively demonstrate that the underlying business is flush with cash and highly profitable. There is absolutely no liquidity crisis happening here. Now, to be perfectly fair and objective, we do have to look at the liabilities. You'll note that there is a debt-to-equity ratio of 1.73, which means, yes, they do utilize leverage. However, the phenomenally high quick ratio of 6.19 proves they can easily, almost effortlessly, cover their immediate liabilities without even having to sell off inventory. So the debt exists, sure, but the liquidity profile makes it entirely manageable. It certainly doesn't explain a 56% drop in share price. To really understand the psychology of the TMDX investor right now, we have to walk through this timeline to show the absolute roller coaster journey they've experienced leading into 2026's sharp decline. Look at 2022, up 222%, then up nearly 28% in 2023, down 21% in 2024, back up a whopping 95% in 2025, only to crash almost 44% in 2026. This is a highly volatile stock that subjects its shareholders to massive cyclical swings, completely regardless of the steady upward trajectory of the actual business fundamentals.
Section 3. Fair Value and the Margin of Safety.
All right, according to the data, here is the big reveal. The EPS-based fair value price is $170.76. Contrast that sharply against the current $68.34 share price. When you actually run a discounted cash flow model based on their earnings per share growth, the math suggests the stock should be trading well over $100 higher than it currently is today.
So, the crucial point here is that this valuation creates an enormous 59.98% margin of safety. For those of you who study value investing principles, you know the margin of safety is your ultimate buffer against being wrong. Buying a fundamentally growing business at nearly a 60% discount to its mathematically calculated intrinsic value, that's a remarkably rare setup in modern markets. It basically means even if the growth slows down significantly, you still have a massive cushion built right into the current price.
Section 4. The final data verdict.
When we put these starkly contrasting realities side by side, honestly, the extreme numbers speak entirely for themselves. On the bear side, the price action is just brutal, down nearly 44% year-to-date and negative over a 3-year holding period. The market just hates this stock right now. But on the bull side, the business itself is absolutely thriving. Net income compounding at 100% annually over 3 years, with a calculated margin of safety sitting at nearly 60%. It's wild. The stock chart says run away, while the balance sheet is screaming buy.
Which leaves us with this final, unavoidable question based purely on the data we've explored today. Are we looking at a broken stock or just a massive discount? Wall Street and the balance sheet are completely divorced from one another when it comes to Transmedics right now. The numbers we've unpacked here are extreme, and I highly encourage you to take this data, dive into the company's reports yourself, and see which side of this fascinating equation you land on. Thanks for joining me on this explainer, and as always, keep questioning the data.